episode 5 of our series Initial Margin for Uncleared Derivatives in 2019 and 2020. Mission IM Possible. In episode 1, we looked at the global rules for IM, their progressive implementation and scope, how IM is held, the documentation architecture, supporting legal opinions and technology solutions. In episode 2, Jonathan Martin, CEO of the alternative legal service provider DRS, and I focused on successfully navigating, negotiating and executing the legal documentation in an IM project. In episode 3, we considered the margin segregation options available for Phase 4 and Phase 5 counterparties from the Custodians perspective with Mark Higgins, Managing Director and Senior Product Manager of BNY Mellon. In episode 4, I was joined by Hiroshi Tanase, Executive Director and Product Manager of IHS Markit, a global leader in information analytics and solutions for both major industries and markets, to consider IM calculation. In episode 5, we look at the 9 key steps in the Phase 4 and Phase 5 compliance process. Self-disclosure, working out which phase, if any, you fall under and in which jurisdictions. Client engagement, working out the best way to get client data on key questions around uncleared margin regulation compliance. Rule distillation, ensuring that you go through the regulatory rules line by line. Legal agreements, custodian onboarding, technology solutions, and in particular understanding the offerings of the various solution providers, utilities and vendors, and to what extent these are indeed needed. Operations, so do you have the necessary back office setup? Collateral optimization, finding and using the best initial margin to post, and IM model ownership. Today, I'm joined by Chetan Joshi, the founding partner of Margin Reform. Margin Reform provides a practitioner-led consultancy and bring a deep and deliberate expertise to the collateral margin and legal domain. Most importantly, Chetan and his team can advise you through these 9 key steps. In episode 2, I outlined how Mayer Brown and DRS have been working together on our Impact Squared platform to offer clients a combined IM service. We've now expanded Impact Squared to become Impact Cubed, working together with Margin Reform to provide a combined offering to clients. Chetan, welcome to episode 5. We've called this episode Mission Impossible. You have named the 9 key steps in the compliance process the Wheel of Pain. So how likely is it that this is going to be Mission IM Possible or Mission IM Impossible?
At Margin Reform, we strongly believe getting compliant to UMR in 2019 and 2020 is not mission impossible. Different regulators have passed you a documented set of rules which need to be digested, understood, and then brought to life through analysis, planning, design and delivery. The mission is to achieve compliance before the clock stops ticking, which for Phase 4 is less than 6 months away, and for Phase 5 that's less than 18 months.
In previous episodes, we've illustrated the issues arising from IM using a hypothetical counterparty, the Cadiz Group. Let's imagine a hypothetical counterparty group. Let's call it the Cadiz Group. The Cadiz Group has 50 billion euros of gross notional amount outstanding derivatives at the measurement point, placing it in Phase 5. It has 10 in-scope entities, including a pension fund and asset management in Denmark, and banking entities in Spain, Italy, France, Switzerland, and Singapore. Those 10 entities have 80 ISDA master agreements in place, with a mixture of entities in Phase 1, 2, 3, 4, and 5 counterparty groups. Those 80 ISDA master agreements are spread over 24 counterparty groups. Chetan, we've identified 9 key points in achieving regulatory compliance for a Phase 4 or Phase 5 counterparty. Let's take a look at this slide. You've called this the Wheel of Pain, and let's take each of these 9 points in turn to consider what setting up and managing an initial margin project would look like if you were advising the Cadiz group? Let's take self-disclosure first and cast our minds back now to episode 1. Am I in or out of scope for a particular phase? That's one of the big questions for any counterparty group. The rules require counterparty groups to look at the aggregate average notional amount of outstanding covered derivatives for the last business day of March, April and May of each year for all entities in the group measured over the observation period. Covered derivatives include all non-cleared derivatives transactions, including intra-group transactions, counting these only once. Generally speaking, the calculation captures all entities which consolidate into financial statements. The calculation is complicated by moving exchange rates and applicable thresholds applying in different currencies depending on the applicable regime. For example, United States dollars for Dodd-Frank and euros for EMIR. What are the key issues in self-disclosure?
So firstly is working out in advance your ANA. With the scenario we've given you, there's multiple jurisdictions in place, so it's important to understand the different rules per jurisdictions. Also look to novate and compress. You don't necessarily need to get pulled into this wheel of pain. You can potentially get out of this wheel of pain. Should you stop trading at all? And looking at the client income, is it greater than the regulatory investment?
What do you mean by novate or compress?
Sure. There are options on the table with regards to the positions you have with your clients. And looking at the entities in the group, there are opportunities to novate those trades away to reduce your ANA calculation. Also looking at the portfolios and looking at ways to compress, which again reduces your notional.
But when you say novate, I mean, you must mean novate outside of the group, because your ANA calculation is going to be on the group for the group as a whole. So taking our example, it's going to be Cadiz group across all of those entities, the pension funds, the asset managers, etc. So you're saying novate them to counterparties outside the group?
Correct. That's one of the options, and we've seen that in the industry where clients have used that as a way of reducing their ANA calculation.
And by compress, you mean it's the quarterly compression cycles that we have in the market. I mean, certainly casting our minds back to pre any of this regulation, we used to see that there were trillions of outstanding derivatives, taking the credit derivatives world, I think it was there 33 trillion of outstanding notional amount of credit derivatives. But what was really happening was each time there was a trade that was cancelled, it was being offset the other way, which led to some form of double counting. And with these compression cycles, we get rid of those offsetting trades. So I take it from what you're saying there is you have an extra eye on your compression cycles. Is there any sort of trades that don't really need to be there, could be compressed, and take them out of the calculation and use the tools available to you to reduce your ANA so that you don't necessarily fall into phase 4 or indeed phase 5, depending on the overall outstanding notional derivatives for the group?
Correct. But there's many options out there, and the vendors out there to help you as well. So as part of the regulations, they promote portfolio compression. So looking at it is really important as an option. Another consideration is, should you stop trading as the client income is greater than the regulatory investment?
Look, I think that's a very valid concern where people are close to the cusp and they're thinking, well, if I fall into phase 5, I've got to put all this infrastructure in place, and perhaps I've got an ANA of 9 billion. And if I stop trading a billion or so and it puts me under that, I don't have all of that regulatory investment. So should I cast off some of those relationships to bring myself under? And for perhaps some of the larger bank or the smaller banks, they might think about cutting that business altogether.
Correct, and we've seen a number of organisations that have stopped trading in certain entities to reduce their investment in the programme. So they go live and then they slowly start trading again. So there are different options. It's worthwhile looking at that to help you.
Oh yeah, I've seen that point where perhaps you've got a group, and we can see this in Cadiz Group. They've got all these entities out there. They might say, actually, I'm going to concentrate all my derivatives trading in that one entity. That way I only have to put the infrastructure in place for one, rather than everybody as I've been doing that, and then sort of ramp it up at a later date.
Exactly, and we've seen that in phases 1, 2, 3.
Certainly going to make it easier to hit the compliance deadlines and then deal with the broader infrastructure later on.
Correct, exactly.
How do you self-disclose? So how would the Cadiz Group self-disclose its ANA and what phase it's going to fall into?
So there's a number of options that they have on the table. One is using the tools out there around ISDA Amend, which has a self-disclosure letter which has been reduced for phases 4 and 5. Another option is just going by email, so depending on how many relationships you have, having a list of questions going out to your clients. And the third option is using your industry body, who are looking to collate all that information and self-disclose to the industry body, who can then cascade it to the rest of the participants. And that's worked really well in the early phases. For example, ISDA have done that. You're allowed to see the different relationships out there.
Probably more difficult as we move into business, some groups, let's take insurance companies and others and pension funds, where derivatives is not the principal business.
Correct, and I think then you have to just go back to the standard kind of emailing your clients. Also working out where your client contact details are. That's another challenge, finding out the right people, who's your legal contact, ops, risk, technology. These are all the key players that you need to interact with in that self-disclosure stage.
Yes, no, I agree. I think finding the right people is a real practical difficulty, particularly for smaller counterparties that maybe have got a new project manager come in from the outside, they're setting up a new team, and it's perhaps a team that people might not be aware of in the broader institution. Certainly it's a challenge in a shorter timeline.
Yes.
So let's turn to our next pain point in the wheel of pain, client engagement. In any project, you're going to need multiple sources of data, and these will need to come from across perhaps an entire group. And you may also need to get data from external providers, other counterparties. So looking again at the Cadiz Group, what's going to be the client engagement issues that the Cadiz Group is going to face in its project?
So one of the challenges around client engagement is understanding who are the key people you need to speak to. Some clients will outsource their legal services to a firm, also working out who the operational people are. And this is where the self-disclosure point is really important, where you understand who are the key people that you need to engage with, and then having a call with them or sending some emails to them just to understand how you're going to go through the rules. That is so important. And in early phases there was a lot of collaboration. As we move into phases 4 and 5, with the volume increasing, that's going to be more difficult for firms to deal with. So client engagement is really important, and using your relationship managers within your organisations that can help you connect with the right clients.
In episode 1 of the series, we touched on how the credit support deed or collateral transfer agreement manages multiple uncleared margin regimes. A collateral agreement regime table allows the parties to comply with the multiple regulatory regimes which may apply under one agreement. For example, a party may be based in the United States and so need to comply with the Dodd-Frank rules. Its counterparty may be based in Spain and need to comply with EMIR. Other regimes may also require compliance, where members of the group are based in another jurisdiction. So, the collateral agreement will provide that IM exchanged must meet the requirements of each regime applying to the parties. A regime table in the schedule to the credit support deed or collateral agreement allows the parties to elect whether a regime is applicable or not applicable for each party. Where two regimes conflict, the strictest of the regimes apply. Documenting this part is fairly easy, but what needs to be done in practice?
The rule distillation is really important, and the regulator is keen for you to understand their rules line by line. So depending on what jurisdictions you fall under, for example in the US you have to go through a regulatory exam for the model, and they're really interested to look at the gap analysis. Have you gone through their rules and worked out where the gaps are and what's your action plan to close those gaps? Also within the rules you need to understand what functional area owns each of those rules. So is it for legal, is it for ops, is it for technology? And then what's the evidence that you can provide them to say that you are compliant to their rules? So is it a policy change, a procedure, a technology change, or a contract change? And so the rule distillation is so important that each jurisdiction has a different way of how you interact with them. So in Europe you need to send it to them self-attest, same in Hong Kong and same in Singapore. So it's really important to go through those rules line by line, make sure people understand them.
I mean, it's one of those things when we're drafting the documents, it's such an easy table to draft because you're putting in, is this regime applicable? Is this one applicable? The strictest of those apply. But getting into the under the bonnet for this, it really is quite complicated because although all of the rules come from the same principles, there's material differences between them, and there is subjective analysis of those rules from the regulators. So taking the Cadiz group, Cadiz group is going to have to satisfy multiple regulators, and that's certainly where the consultancy-based service is going to look at that and make sure that all of the jurisdictions are complied with on a line-by-line basis, because of course if they don't comply, well, there is the risk of fines.
Correct, and at Margin Reform we've broken those rules line by line, so we can come into organisation and drop those rules broken down into those different functional areas and work with the clients, educate them on what rules apply to each area. And you mentioned one of the key challenges is interpretation. Mm-hmm. How do you interpret a rule is completely different to someone else, so collectively as a group you need to make sure that you document that interpretation. Yep. So when the regulator comes in, there is a method to your madness, and they can understand how you got there. If you don't do that, then there's obviously more regulatory scrutiny, and we've seen that with in the US with regulators really looking at the way the rules are digested and managed.
So you're saying it's not enough to say, well, the Swiss regulator said that was okay, or the US regulator said that's okay. The regulator's going to want to say, no, this is what our interpretation and what's okay.
Correct. And
you've been able to say yes, and we've satisfied your interpretation.
Exactly, and you have someone within your organisation, a senior manager, that can stand by those rules for their functional area.
In episode 2, I discussed with Jonathan Martin, CEO of DRS, successfully navigating, negotiating and executing the legal documentation in an IM project.
It's not an exact science, but our experiences to date working on phase 1 to 3 implementation show that an individual can manage a portfolio of 25 to 30 negotiations at most. And on average, you should allow for roughly 4 months to complete the end-to-end process of counterparty and custodian negotiations. So for a set of 300 documents, depending on how they might be phased or staggered, we would probably need to deploy a team of 6 to 8 people, a team leader and 5 to 6 negotiators. They would in turn be supported at all times by experts on hand to assist with complex issues.
What's your take on this and the documentation process?
In our Wheel of Pain, this is the first significant challenge for the industry. It's one of the biggest areas of investment and time. Early phase firms have used a number of short-term resources to help solve the problem around the negotiation process. The industry is now moving to more centralised automated solutions to help automate this. It's one of the biggest challenges that I face managing a project is the number of people you need to manage within legal and the documentation team. Let's also discuss technology. The collateral ecosystem is getting busy with so many solution providers out there and utilities helping you to deal with this from a technology point of view. So if the Cadiz group took Impact Cubed, that would help them have a team which can help centralise their negotiations, a point of contact to help navigate through all the different challenges that apply with legal documentation.
And I agree, and I think one of the additional challenges to that is Cadiz Group has that infrastructure supporting it. I thought Jonathan summed it up perfectly about the level of documentation support and negotiators you need to do that. Of course, the additional challenge is, what if your counterparty is not so well set up? So there you are, you've reached out, you've got the documents out, and there's no response because they don't have the right people in place, or there's not the right lines of communication, something we touched on a little bit earlier, at the counterparties that Cadiz is facing. Again, it's creeping towards the deadline. Is that a a likely problem?
Yes, definitely. It's a very big challenge that we have seen in the industry, is where you might have a stronger outfit understand the documents. So with the Impact Cube, we have an organisation that's been there with phases 1, 2 and 3. They know the challenges that the organisation will face, and they'll help those counterparts get through those challenges and those hurdles.
I mean, I think the industry's recognised what a massive challenge there is, and for that reason there are technology solutions on offer. And we have is to create, we have margin exchange, we covered that to some extent in episode 1. What's your view? What are the challenges of using those two systems or one system? And what are your thoughts about that?
Sure. So those online solutions are a great way of automating the negotiation process. Without those solutions, it's very difficult to figure out where your documents are and where the bottlenecks are. So these solutions out there by is to create a margin exchange really help you understand where the challenges are. It also provides great management information around the documentation. The technology challenges are embedding those solutions into your infrastructure.
Yep.
So you need to have the right technology to kind of onboard them in the relevant timeframes. One of the challenges I see around those tools is, will everyone be on those tools?
Yeah.
And there is flexibility to use those tools in different ways. So you can have clients that aren't on the tool and you pull the data in and out. So there is that flexibility. But again, you're relying on your technology team to work with your legal team to embed them. But they are going to accelerate the negotiation process, in my view.
In episode 3, I was joined by Mark Higgins of BNY Mellon, and we considered the margin segregation options available for Phase 4 and Phase 5 counterparties, how to source the right collateral to meet IM regulatory obligations, the differences between tri-party and third-party collateral management, and what may be right for an individual counterparty group, such as the Cadiz group, as well as collateral transformation, so how you convert assets to meet what's needed to comply with market obligations. What do you think are the key issues for custodian onboarding and collateral optimization?
Sure, the key challenge, step 1, is around KYC and AML. So one of the key things from a margin reform perspective that we advise our clients is to start the onboarding process straight away. Even though you're a Phase 5 or a Phase 4, figure out who your custodian is, and as the episode Mark provided the differences between third party and tri-party, which is also a challenge to understand with different pros and cons. Once you've figured out your custodian, is going through that onboarding process, which can take 3 to 6 months, depending on the custodians. Also, one of the challenges is around the documentation each of those custodians have and filling out those forms internally. And earlier we were talking about the Cadiz group having multiple entities. There'll be multiple people to sign those documents. So starting that process takes time and understanding who the right people are. So once you've figured out your KYC, your AML checks, you then go into kind of what collateral you're going to use. And then the regulations are very broad on what you can post as collateral. So working with your front office desk, understanding what collateral you're going to post is key. What is the cheapest to deliver? What's the best to recall? So having those conversations with front office and credit is important.
So I guess the key message is this is trickier than you'd think it would be.
Correct. I underestimated the challenges around the custodian, and people normally do because it's seen as a back office function. It's one of the last things you do. But the custodian has the power now to stop you from trading. If the accounts aren't set up and you're not allowed to trade, that's a regulatory breach. So it's really important that the custodian is chosen very early and the onboarding process is done within time.
I've heard that SWIFT connectivity is a big issue as well.
Correct, and one of the challenges is around how you communicate to your custodians. So the different SWIFT messaging types, so you have these MT527s and RQVs, all these different terms. It's understanding what these terms mean and making sure that you have the right SWIFT capability. There is also vendors out there helping you remove that headache away and transforming the messages internally from your systems to the external custodians. And when you look at phases 4 and 5, we're going to move away from the 4 main tri-party agents that we had for phases 1, 2 and 3 to now up to 10 to 15 custodians. So now you need to connect to all of those custodians, and the way you open your account with a custodian is by sending a SWIFT message. So you need that capability, and that's really important to plan that in your technology stack.
No, it's interesting, as a lawyer, normally my engagement with SWIFT is writing in the document SWIFT and then a number. And it's not often I'm blinded by acronyms, but there's a whole new world for me out there, and I can appreciate that's a really complex area that needs to be dealt with as part of the process.
Yeah, and that's why when you look at phases 5, the fund administrators, the people that run the back office, the settlements people, that's when they come into this process. And they're really important in helping you be able to settle and move the collateral. Also within the regulations, you need to move collateral T+1. So if you do an interest rate swap today, the collateral needs to move tomorrow. And that's where the settlements team needs to be engaged and making sure that the right SWIFT messages are going out.
And how about optimization? Any other key issues on collateral optimization?
Sure, when we looked at phases 1, 2 and 3 for clients, the eligible collateral was very, very narrow. organisations are now looking to expand the scope of collateral. The regulations allow you to use money market funds, allow you to use UCITS. So a number of these phases 4 and 5 have assets that might not be eligible, and to your earlier point, they can transform that collateral, or what we call a collateral upgrade trade, moving it from ineligible to eligible. So optimisation is very, very important, especially as more clients get pulled into the regulation, your exposure increases, so that your pool of collateral will potentially diminish. So now you need to look at different sources of collateral to be able to post to the volume that's coming in 2020.
Chetan, we've both been speaking in multiple jurisdictions together on IM issues. In fact, last month we had a nice trip to Frankfurt together. Outside of the forums we've done, we go out and we speak to clients on the ground, particularly for phase 4 and 5 entities, having the right operation staffs to manage the IM process after the compliance date is a key issue, isn't it?
Correct. So historically, the operations within collateral management have had one margin call per client to process. Now with initial margin being introduced, you now have gross IM, so 2 IM numbers. So the volume of your collateral calls will increase.
Yeah.
So for the operational team, there's a big impact. Firstly, dealing with that volume of margin calls, being able to then move that collateral to different custodians using SWIFT, as we talked about earlier. But custodians have different ways of communicating, portals, faxes. Yeah. So the operational team needs to ramp up and be able to deal with all that. Some clients might outsource that to an outsourced provider. Also, the skill set needs to change. So when you're reconciling the collateral, especially for initial margin, it's based on sensitivities. So now that skill set needs to change, and what we've seen historically is organisations having 2 teams, an operational team just starting off with the matching of the trades, and then handing over to the risk team to deal with the risk sensitivities, because that's more a different skill set. So overall, operations need to be involved in the whole wheel of pain as part of making sure they can enforce the collateral, they can monitor it, they can move collateral in a timely manner, but also reconcile.
In episode 4, I was joined by Hiroshi Tanase of IHS Markit, and we provided an overview of the initial margin calculation that needs to be performed, and we looked at the fundamental definition of initial margin and the different specific calculation methodology. What do you think are the key issues for Cadiz Group in relation to the IM model?
Sure, so there are a number of challenges around the IM model. Firstly is, who owns the IM model? Is it owned by risk? Is it owned by the front office? And that's one of the biggest challenges that we see when we're advising clients around it. Most of the market has moved towards a risk model owner. Once you've figured out the risk model owner, it's understanding what are the kind of daily procedures they need to have around the IM. With the IM, there are 2 main methods you can use, which is around the ISDA-SIM, the standard initial margin model, which the whole market is moving towards and using for phases 1, 2 and 3. And then you have the regulatory scheduled grid, which is looking at percentage of notional. So each of them have pros and cons in the implementation. So I think the challenge isn't around the calculation, the challenge is around the model governance. And also there are requirements around back testing. So the model is obviously predicting the future risk. You need to make sure that from every 3 months, from a back testing point of view, you have resources to look at the data, to write a report, to say if SIM is performing the way it should be. So there's a lot of guidance in the industry around that, but there's a lot of work that is needed around the SIM, and people underestimate the work that needs to be done. So once you go live in September 19 or September 2020, there's an ongoing monitoring and model performance you need to do. Also around disputes, who's going to manage your disputes? Who's your first line defence, second line defence, third line defence? So the model brings in a lot more governance and control that organisations have never experienced before. And it's been a big challenge for the early phase firms. And there are organisations that can help you do that. And that's something that we're helping clients to write the report, help them do the back testing, and also provide them the kind of advice around dispute management.
So Chetan, any final thoughts?
The key message is to start early. We've obviously described a wheel of pain, but this can also automatically change into a service wheel. So you're able to outsource some of these things to experts out there in the industry. So having those conversations, there are a limited amount of people out there that have gone through this a number of times that can help you accelerate your program of work, but also guide you through this and transform you to mitigate any kind of gaps and controls you have. So start now is the key message. At Margin Reform, we offer an initial margin workshop with our strategic partners, which is a quick way to bring out your risks and issues. The workshop can be as short as half a day through to 2 whole days. 2 outputs are provided post-workshop. on capital report around the SIM and an operational assessment report that can be utilised to sense check your compliance journey and to accompany and complement any existing plans or strategies that you have already.
So to conclude, it's very much mission I am possible and not mission impossible, at least if you put in the preparation and the infrastructure that we've described today. If you were a Phase 4 or Phase 5 counterparty group, or a Phase 1, 2 or 3 counterparty group revisiting how you carry out Phases 4 and 5, and you like the approach taken in our film for the Cadiz group, then the approach that Mayer Brown, DRS and Margin Reform have created together with our Impact Cubed platform may be for you. We'd love to hear from you. If you've made it this far, I look forward to seeing you for the next episode.